This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
On today's show, we look at the other side of the spectrum on monetary policy, not just raising or lowering interest rates, but the Fed's massive balance sheet, and then an update on a holding in our portfolio. Welcome to the Wise Investor Show podcast. I'm Chase Hinderstein, one of the portfolio managers here. And today, I'm going to get back to a brief focus on inflation and monetary policy. But if you hang in there, I'll finish up the show with a specific stock or two. And, if you listen to most of these shows, you've heard me a couple of weeks ago talking about contrasting forecasts for the year. And if you listened for a long time, you've also heard me refer often to the first and second day of econ class, where it's emphasized that we shouldn't guess where interest rates are going. Then, as that student in econ, you set forth for the next few years, learning about how to guess where interest rates may be going. And I heard Mohamed Al-Arian this week talking about how if the Fed doesn't cut rates by the end of the year, it's going to be a huge policy mistake. So, I guess he thinks he knows something about where it's all going. And, if anyone does, he might. I really am not criticizing him here. I do respect his outlook, which is why I listen when he's on. But the markets have finished last year by pricing in an expectation for 6 interest rate cuts for this year. And I've repeated that while I'm optimistic, I'm concerned that if we don't get all the good that's already priced in here, the results may be rocky, despite what will be otherwise good results as far as the economy and earnings growth. They teach you not to guess where interest rates are going, but it's hard to model anything for the future, the value of earnings for the coming years, the growth in the economy or what have you, if you don't at least cook in an estimate for interest rates. Even our financial plans here, we have to bake in this assumption of inflation for the clients, but we approach that in that case by using a number well above normal averages in the U.S., and then that hopefully leaves room for error, building the plans on conservative assumptions. So I'm surprised to see how much conviction there is in those that are leveraged to the scale of and the timing of these interest rate cuts this year. And I'm worried that then if we maybe as a whole, as a group, are too leveraged to them as a base case, while the messaging from the Fed here is clearly to temper those expectations, and the data is suggesting that it's just not a foregone conclusion. Remember, we're here now, starting this year with the key benchmark, right? The 10-year Treasury rate, which is, let's say, about 4% today, is basically right about where it was when it started 2023, 12 months ago. So it's almost as if nothing's happened. If you looked at the interest rate beginning of last year and where we are today, nothing happened. We can forget that it trended higher and higher, finally actually was yielding more than 5% just back in October before trailing back down now back to where it started a year ago. Now, of course, this was a year that the Fed continued to raise interest rates. So it's interesting to note that the so-called benchmark rate ultimately was unchanged. And that's because the Fed doesn't control 10-year benchmark interest rates. But what they do is they adjust short-term lending rates, overnight lending rates, while also they tinker with the very long end of the yield curve through quantitative measures. But also that these prevailing rates are not about what the Fed is doing today. They're pricing in the future. The benchmark rate is not dialed in by the Fed, but it's set by the market's impression of what the Fed may do, and more importantly, what inflation may be doing to drive these respective rates. We started 2023 with the 10-year passing these levels we're at now as they headed on the way up, and we ended the year passing through them on the way back down. But we got to be careful here because while they did trend below 4% a few weeks ago, they've now risen back over it as that foregone conclusion that the battle was over and interest rate cuts were around the corner. Well, now it's somewhat being called into question. At the end of last week, we had pretty benign producer price index results, which will lead into, predictably or theoretically, will lead soon into benign and lower inflation speaking PCE numbers soon. But on Thursday, we got the latest consumer price index data for the month of December, and it was, while lower than the previous month, it was higher than expectations, coming in at an annual rate in the core rate at a 3.9% inflation rate versus the FactSet consensus estimates of 3.8%. And at the same time, continuing jobless claims were lower than the estimate, and hourly earnings were higher, thankfully higher than inflation for those earning those average hourly earnings. So in this data dump, it all pointed to inflation, not certainly terribly where it was over 12 months ago, but not thoroughly licked just yet, which is what the Fed has been looking for, right? Higher for longer, not making the mistakes of the Volcker years of starting and stopping. They want to have real assurity that inflation is gone. Still, it's just not being received as bad news, and it's not terrible, but the responses are taking away, again, what they want to hear. Just as Wall Street heard what it wanted to hear when Jerome Powell spoke after the last Fed meeting. In the Wall Street Journal last Thursday, the summary of the inflation release blew through the data quickly and pivoted to last month's PC index, which they focused on as a 6-month rolling average number that was coming in at 1.9%, and that it appeared to track below the Fed's stated target of 2%. So if you use a very unique set of data, you can get the result you want. And, this isn't complete fallacy. It's a good contrasting point of data versus that which would point to continuing inflation, but to use it as the only focus and to use it as this bottom line conclusion, that's what can get you into trouble this year. But still, as I keep saying, I am optimistic that we can see this trend improve and see some interest rate cuts this year. But I don't want to be the most dovish voice out there when we see stock prices building it in as seemingly as a foregone conclusion. However, another aspect of monetary policy's battle against inflation that I wanted to really bring up this week is the less appreciated, it's out there, but what we don't talk about as frequently, the so-called quantitative tightening that goes on behind the scenes and has continued despite the Fed pausing their short-term interest rate cuts. Now, quantitative easing was introduced in modern times in 2009 during the so-called Great Financial Crisis and brought back in strong form during the pandemic in 2020 and continued through 2022. And simply put, quantitative easing is the Fed, after they've done lowered interest rates basically to zero, they didn't want to go ahead and experiment with so-called negative rates that some countries did. So they started instead, their new technique was they go out and started purchasing long-term treasuries and long-term mortgage bonds and doing so in the hundreds of billions of dollars worth. From 2020 to 2022, according to the Richmond Fed, the Fed increased their balance sheet from $4 to $9 trillion through these purchases. It was already at $4 trillion because of the quantitative easing that they had started in 2008 and maintained their balance sheet size. So now they ratcheted up to $9 trillion through quantitative easing. And the effect this has is that when you increase the demand for an asset, when you go out and buy a bunch of bonds, you jack up the price. You increase the demand, you make the price higher, and on bonds, prices go up, the yields go lower, and part of this effect then is to lower long-term interest rates, namely, as far as the economy is concerned, mortgages. And you make borrowing that much cheaper and juice the economy by doing so. However, also in application, the way it's basically achieved is that the Fed buys these bonds by taking them from large banks off their balance sheets. These are assets that the banks purchase with the reserves, and they replace them on the bank balance sheet with basically what amounts to an IOU, their equivalent of cash, and puts the bonds on the hands of the Fed. And this is basically, in essence, is the Fed creating cash. It does increase the overall money supply and it injects liquidity into the economy. These credits to the banks are a currency, and the banks can then take that credited value and essentially lend it out in various forms. Now, for many years over the last decade, And until not long ago, the Fed was maintaining that balance sheet. They weren't necessarily increasing their purchasing power, but as bonds would mature, they would take the cash and buy more bonds on the street, keeping at least the status quo in place until recently when they decided, in addition to fighting inflation with raising interest rates, they'd fight it by allowing their balance sheet to wind down a bit. And they talked about this a few years ago before the pandemic, and we had the taper tantrum because this was the tapering the balance sheet, and Wall Street did not like the idea that they were going to allow long-term interest rates to rise. But now they started it actually in real form. They'd allow their bonds to mature, and they wouldn't use those proceeds to buy new ones. And this has the effect of drawing down the total money supply and drawing liquidity out of the system. They created money out of thin air, and now it would evaporate into thin air as these bonds were retired. Well, long-term rates would then tend to rise, and cash would be just that much less available, making the spreads on loans versus the benchmark rates rise even more, which I've talked about before. As the spreads rise and lending is that much more, therefore, expensive, which we certainly have seen recently, even with this inverted yield curve, it combats inflation, but it does so by slowing economic activity and slowing down lending, the availability of lending, the cost of lending, the occurrence, therefore, of lending. So with all the talk of the Fed cutting interest rates, it's not also surprising to see now that folks are talking about ending this quantitative tightening and that maybe the Fed should revert back to maintaining its current balance sheet at this point, whereby now the Fed's balance sheet, again, according to the Richmond Fed, is down to $7.2 trillion in holdings versus a little bit over $9 trillion it was not too very long ago. Now, according to the Financial Times this week, the minutes from the most recent Fed meeting showed that some policymakers looking to discuss the ongoing expectations and plans for quantitative tightening, as they're also tasked with maintaining an orderly banking system. The Fed does have other things on their mandate. They need an orderly banking system, and they've been looking at the potential for some liquidity issues within some recent bond auctions and the overnight repo program. Not real trouble yet, but they keep an eye on that, and they're pivoting back to maintaining this steady balance sheet because it would also add liquidity and demand for that marketplace. But it's going to be interesting to see, ultimately, if the data is there to warrant this pause or if the Fed will be looking to get their balance sheet back into a position that is more historically representative of how they've done things. Today, it absolutely dwarfs any previous comparison relative to the U.S. GDP, and they're not really supposed to be in the mortgage-owning business. Arguing against ending the tightening and keeping them winding it down, we can see other data recently as Securities, a firm of analysts that we follow, released a report on Thursday that showed the spreads of mortgages to Treasury rates are now below the average level they've traded at over the last 20 years. Now, surely quantitative easing can bring down both interest rates on an absolute level and lower mortgage rates help the economy in many ways, but seeing this spread contract to where it is now at 46 basis points above the respective Treasury versus a spike close to 90 basis points, which spiked over 90 basis points twice over the last couple of years, as recently as October, that's a sign that lending today is more benign for the consumer and should reassure some of those at the Fed that they want to keep that they don't maybe have to keep pumping as much cash into the system. Overall rates have headed lower, although long-term rates are up so far this year, but the trend has been lower, and with the respective spreads for borrowers to the benchmark rates also trending lower, it's already a far more favorable, accommodative market for borrowers than it was just 6 months ago. The banking system is operating normally. Capital is flowing. So if we're still not sure about inflation and we hear them saying and repeating higher for longer from the folks over at the Fed, then we should be careful with those that expect too much more this year and trade off of that as a thesis. We may see more accommodative monetary policy as the year goes on. I have been saying I expect us to, get the favor of the Fed and probably see some interest rate cuts, but maybe just not as optimistic as the most optimistic voices out there who expect us to go back to the policies that we, basically enjoyed over the last decade. All right, I'm up against a quick break here, so give me a few moments. I'll be back in a minute with some specifics about a big holding in our portfolio. For the Wise Investor Show, I'm Chase Hinderstein, and I'll be back in a moment.
The buy tech and high multiple growth stocks playbook of the past few years is no longer a winning strategy, but dividend payers are outperforming. Have you reviewed your portfolio to meet today's updated market conditions? I'm Simon Hamilton with the Wise Investor Show. Every week we discuss the latest financial trends and what investors need to know about them. To learn more about how market leadership has shifted and to become a better informed wise investor, listen to the Wise Investor Show at thewiseinvestorgroup.com or find us on your favorite podcast app.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. With the remainder of today's show, I want to share a quick update from Danaher. And first comment, some weird market reaction regarding it. And because you're probably familiar with the name. It's one of our larger holdings, large holding in our clients' portfolios, and also a name I own. So me here shedding a positive light on it does have an inherent conflict of interest because I own the stock and want it to go higher. But last week, there was this big healthcare conference in California, maybe one of the largest ones, hosted by JP Morgan. And because of that, heading into that conference as a presenter, Danaher essentially pre-announced their end-of-year quarterly results in the days leading up to the conference. And the results were generally regarded as a good surprise. They were beating the expectations that Wall Street had for them. They did announce a decline in revenue, which was already the expectation off of the previous guidance, and it reflects a tailing off of. The reason the revenues are lower is because of they had tremendous boon, a huge tailwind from various testings regarding to COVID. Essentially, Danaher was making a lot of money off of COVID. So they did see lower revenue as that boon in COVID money has dwindled a bit. But they now said that the quarterly decline in revenues would be less than previously expected, and it was received as good news, and the stock rallied, traded substantially higher that morning. However, later in the day, the overall market, and especially the healthcare sector, began to trade lower, and the gains from Danaher that morning were lost. And because of that, at the end of the day, when the headlines were written by various parts of the financial media, they wrote the headline that Danaher stock sold off after releasing lousy guidance. And my point being here is that it's just sloppy, lazy reporting and based on false conclusions as they were drawing a line between the two outcomes. They pre-announced their results and the stock traded lower. But no, the pre-announcement itself was widely accepted as a positive announcement. But for what it's worth, and now I'm going to pull from the JP Morgan research report published on January 5th, the better than expected revenues were driven by Danaher's Cepheid testing revenue, which was north of $600 million for the quarter versus the previous guidance of $350 million for the quarter and JP Morgan's own expectations of $375 million a quarter. So they got a lot of more revenue from that space. In fact, at the conference itself, their CEO said regarding Cepheid that, quote, "The pandemic was quite an infomercial for Cepheid because our hospital technicians and doctors became so accustomed to getting to the right answer with such quick and easy workflow," end quote. And what Danaher is doing now is they're providing the best testing available for everyday needs, what you might encounter on your own, coming out with a triple test, one size fits all, combination of flu, COVID, and RSV. But more importantly, in the hospitals, in the clinics out there, they have the technology that allows to quickly get to a diagnosis and figure out what's afflicting a patient. Take a sample, put it into the computer, Danaher's computer on site, and get a quick answer. Continuing on, the CFO went on to say they took what was basically a huge cash windfall that came in earnings from the pandemic, and they invested into what he called a, quote, highly profitable growing annuity, end quote, through 2 acquisitions in leading gene therapy technologies that combined those 2 investments now represent $1 billion in annualized revenue, high single-digit annual growth, and 60% growth margins. And I'm going to get back to those numbers in a second, because back to J.P. Morgan's takeaways from the presentation, they point out or shared from Danaher that the company now has transitioned over the past 6 years, which included a pretty wild ride from the pandemic in the middle. They've transitioned to becoming now a pure life sciences company, moving from what was a mid-single-digit growth portfolio to a high single-digit growth expectation, with gross margins improving overall from mid-50s to now 60% plus, and annual cash flow has grown from $4 billion a year to $6 billion a year. Now, the big issues in the near term to still watch are sales in China, where the company said at the conference they expect them now to have leveled off and reset, meaning not going lower, but reset at a lower base expectation. And overall revenues, which continue from both COVID and the subsequent combination of overall testing for various viruses, which the company and Wall Street basically discount out of estimates because they're not considered lasting sources of revenue, but also which have continued to bring in earnings without a real end in sight. It just doesn't count, I guess. But the stock has basically been flat for a year now after what was a tremendous run-up till the end of 2021. And I'm not going to claim by any means that it's on sale today, but I just like what they do and how they're positioned in one of the more resilient sectors of the global economy, the various demands of the life sciences world to both diagnose for the actual patients in hospital-type settings or to develop therapeutics and pharmaceuticals in the labs. All right, that's it for me this week. I appreciate, as always, you listening in. I hope you're avoiding these bugs that are afflicting so many of us, and I hope that you're staying warm. For the Wise Investor Show, I'm Chase Hinderstein. Thanks for tuning in.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.